What's going on, everybody? Good evening. Nice to see you all tonight. How's everybody doing tonight? Spike's doing all right, you guess. What's going on, Spike? Just all right. It's a great day. Beautiful evening for us in lecture. Oh, work, bad day. I think it's definitely a skill to try and not let things that happen in work or in the financial markets affect your personal life. I can't tell you exactly what happened at your specific day. Maybe it was super bad, but at least in trading, I try my best to be super intentional about never letting something that happens in the market impact how I feel when I'm not trading. It's just never worth it for me. Like if I take a loss in a day, I'm not gonna let that ruin my whole day. I'm not gonna let that ruin how I act around other people. Red day, but live to fight another day. Yeah, it was a difficult day, Husky. Me personally, I kind of was waiting for today to start to really think through some trade ideas. I wanted to, as you guys probably know, I've been taking it pretty easy. After today, though, I do want to start getting more involved back in and start ramping back up. I'm gonna send one other message out. I'm surprised I only see 10 people in here. Um, Let me make sure. I really do want to start with a pretty detailed kind of rundown of what came out of the FOMC today. Um, let's see. They did. Say most of you probably. All right. Sent out one other message. We'll give it one more minute and then we'll get started. All right. I don't want to keep everybody waiting any longer. So let's get right into it, everybody. Um, as you guys probably realized, this lecture was titled Candlesticks. But most of you probably know this isn't the first time we've had a lecture on candlesticks, and it probably won't be the last. And even some names in here, I'm probably certain that you've been to one of these lectures on candlesticks before. What I wanted to do with today being a Wednesday, where we had the FOMC meeting, I wanted to start out by giving an introduction into kind of what even happened today. Make sure you guys all understand kind of what the FOMC is, as it's going to continue to be impactful as it has been over the past 70-ish years that it's existed, probably longer, probably closer to 90. So I want to kind of talk about that, give a quick rundown to you all on really what's going on, talk about some of the impacts, talk about some of the decisions that were made, and in the future, some things for you all to pay attention to. So let's start simple, really quick. Right now, we're looking at the SPY. You can see, we'll just take a quick look at intraday price action. I think hopefully most of you should be able to identify where the FOMC meeting minutes were released. It happened right at 11 a.m. You can see pretty massive rip during the day, and then right after that report was published, and then right around 11:30 is when Jerome Powell typically gets on the mic and answers questions and provides any discussion topics. So before I get too far into this topic, you might be wondering, what is FOMC? And that stands for, it's an acronym that stands for the Federal Open Market Committee. That is a kind of part of the Federal Reserve, and it's a function of the Federal Reserve's purpose. The Federal Reserve typically, or I guess, was established to regulate the monetary supply in the United States. I think it was established, it was either in the 30s or the 50s. I can't remember. I guess we could look that up right now. When was the Fed established? Oh, wow. Never mind. I'm way wrong. The tens. Okay. So the Federal Reserve has been around for 110 years. Essentially, some people have their opinions about them, but a lot of what they do is control the monetary supply in the United States. And what that looks like, and kind of the biggest lever that they have in order to control things, is they set a target interest rate, which essentially determines the cost of money in the United States. And considering the United States is such a globalized economy, it has impacts across the world. So just to keep it short and sweet, the Federal Reserve sets a target interest rate, which large, significant banks have to pay in order to lend, or I should say, borrow money from the US government. So what that looks like is, for example, let's say JP Morgan wants to borrow money from the Federal Reserve. What they would need to do is they would need to pay that money, or pay that money back plus whatever interest rate the Federal Reserve had set at that period of time. And we can take a look at the historical interest rates real quick. Historical target Fed funds rate. So we can see the historic, this isn't, no, I don't think this is really the best chart, but what the hell is that? Okay, this is kind of disgusting. This isn't my favorite chart. I like this one better, I think. This is still not exactly what I was looking for. Yeah, this is not exactly the graph I'm looking for. Anyway, I won't show you guys over the entire kind of period of time since the beginning of history, but essentially the Federal Reserve has control over this federal funds target rate. And you can kind of see how that's changed over time. So it kind of moves in increments. You can see kind of it stepped up, or it was in the process of stepping up before COVID. And then obviously once COVID hit, rates were quickly moved back to zero. Coming out of COVID in early 2022, rates began moving higher. In 25 to 50 to 75 base point increases to now, which has currently set the target rate to about 5.25 to 5.5%. And what that means is, again, if I was, for example, to try and go borrow money from the federal government, I would probably be paying somewhere between 5.25 and 5.5%. Now, obviously, people like individuals like you and I can't just go borrow money from the Fed. So what happens is large banks borrow from the Federal Reserve. The Federal Reserve expects to receive the interest back in profit, essentially. But also the bigger banks like Chase, JP Morgan, Bank of America, etc., also charge interest, right? I think every single one of us is familiar with getting charged interest, whether we have a mortgage, a car payment, a credit card payment. Everybody should be reasonably familiar with what that is. And you probably should be able to recognize the fact that you are not paying, or probably have not seen, an interest rate of 5.25 to 5% on anything that you have borrowed in the last 2-ish years. And the reasoning behind that is because once the banks borrow from the Fed, the banks slap their own interest rate on top of that money in order for them to make money as well. So with that said, the higher the interest rate is for the Federal Reserve, or their target rate that they're setting, the higher the interest rate is for consumers down the line. And what that means is the cost of money goes up. And typically speaking, when we see interest rates trend higher, it doesn't stimulate the economy to spend more money, right? Because when the cost of money is higher, we're going to be less inclined to buy cars, buy homes, et cetera, et cetera, et cetera, right? You could extend that for a lot of different things. Whereas when the cost of money is cheaper, when the Federal Reserve has interest rates lower, more people are going to be inclined to buy homes, or take on mortgages or take on new debt, because the cost of money is essentially nothing. And you could even think of this as, like, for example, when a car dealership does like a 0 APR deal, you're probably going to be more inclined to purchase the car and take on that debt when interest rates are near zero, as opposed to when the interest rate on a car is 10%, right? I hope a lot of you guys could probably relate to that, or at least understand if you haven't purchased a car before, new, you probably should be able to reason that if the interest rate on that vehicle was zero as opposed to 10%, you'd probably prefer to buy that car when the interest rate was 0%. So this was a long way of me describing that essentially interest rates can be a very powerful tool for the Federal Reserve to either stimulate the growth of the economy or hinder the growth of the economy. And this is really a tool that they use to ultimately moderate inflation. That's kind of their number one primary goal right now, or at least has been their primary goal, is lowering the rate of inflation. And their main kind of strategy in order to do that was to raise their target rate. And as you guys probably know, the target rate has been around 5% for about the last year, ever since July of 2023. So a bit over a year, the target rate has remained completely constant. And today was the first day that the Federal Reserve actually lowered rates. This was the first time they have lowered rates since essentially COVID. So it's been almost 4.5 years. So with that, that was kind of an introduction to what the Fed is and kind of the decision that they made today. Any questions so far? Any comments, concerns? Obviously, this wasn't what the lecture was scheduled for, so maybe you guys are like, I really wish we were talking about candlesticks. But trust me, this is a topic that so many people don't understand and definitely probably should. Cool. Aaron's feeling good. Any other questions or comments before we continue on? Yeah, great question, Kyle. So BPS is essentially just a fancy way of saying like a fraction of percent. It's called, the acronym stands for basis points. So essentially a 50 basis point cut, or BPS cut, essentially represents a 0.5% rate cut, meaning that rates dropped, I don't know, from 5.5% to 5%. Yeah, so essentially rates right now, if you were to just say them out, 5.5% interest rate from the Fed is 550 basis points. I don't know why people decided that they needed to be fancy with the whole basis points things. We couldn't just say percent, but anyway, I guess maybe it's more clear for some people. All right, so moving on, like we talked about in a little bit earlier when we were reviewing the chart here, this candlestick at 11 was entirely as a result of the release of this press release. And you can see this was for release at 2 p.m. today on September 18th. And pretty briefly, this press release just says kind of a nice quick summary of what the Fed is thinking and how they decided to change interest rates. So you can see here, the committee decided to lower the target range for the federal funds rate by 0.5 percentage point to this. And a pretty common way to analyze this letter is looking how it has changed from the prior letter. And this was a pretty good summary of that I wanted to just kind of pull up really quick, where this person has essentially marked up the differences between last FOMC's letter and this FOMC's letter. So this last one was back at the end of July. So you can see some of the changes that they've made. Instead of saying job gains have moderated, they're now saying that they have slowed. They're now more confident that inflation has made further progress to their 2% goal, but acknowledging that it's still a bit above that. They've also acknowledged that inflation is moving sustainably towards 2%. They've seen the progress that they're expecting. The one other thing that they highlighted, I'm trying to figure it out. Yeah, so they added this line on supporting maximum employment. So for those of you who are kind of in tune with some of the data that has been coming out recently, there's been some pretty strong trends with the unemployment rate and the kind of job openings trends, where we're seeing job openings trend down, net increase in payrolls trend down, and also we're seeing inflation trend down. So really what we're seeing is the Fed make progress. Fed is making progress on their main mandate, which is lowering inflation. The inflation rate that they are, or the metric that they look for inflation, is the PCE. It's the producer cost. I don't know why it's E. I thought it was index, but anyway, their main metric for inflation is PCE, is really what they're targeting. And that essentially is, I'm not going to get too far into it, but essentially that represents inflation. We'll just leave it at that. So everybody should be familiar that that number was, significantly higher. I can't speak on what the PCE number specifically was, but a lot of you probably have heard about the CPI number, the Consumer Price Index, which was up over 9%, not too much more than a year ago. So let's just take a quick look at this. The other kind of important thing that the Federal Reserve released on this meeting is they released a summary of their economic projections, which pretty much describes exactly what they think is going to continue to happen and what's going to be driving their policy. And they compare it to what they thought in June. So first off, you can see in June, they projected that the unemployment rate for 2024 would be around 4%, which is reasonably high based on what they typically like to see. Now they're projecting that the unemployment rate has increased to 4.4%. So anyway, they're kind of acknowledging that tick up. Also, you could see this PCE inflation. Previously, they thought it would be 2.6% at the end of 2024. Now they're thinking 2.3 at the end of 2024, with a longer run goal of still 2%. So what these kind of two main things are showing, the unemployment rate and the PCE are showing here, and kind of the way to interpret this is that the Federal Reserve is now acknowledging that inflation is certainly dropping towards their longer run goal. However, unemployment is now increasing above their prior projections. And I guess all about the Fed's dual mandate is what they call it, is they're looking to lower inflation and maximize the amount of people that are employed. And when that becomes out of balance, they're looking to make changes in their policy. So essentially what they've done today is they've acknowledged that inflation has moved closer to their goal, which they're happy about, and also acknowledged that unemployment has now deviated a little bit above their target. So what they're trying to do is they're trying to lower rates in order to kind of help stimulate the economy very slightly. I don't even know if I should really call it stimulate, but hinder the economy less in order to help that unemployment rate moderate down while also continuing to help that inflation number will continue to trend down. And there's a lot of cool plots that are also included in here. I'm not going to necessarily talk through every single one. I think this is really the most important one here. This is kind of a dot plot that shows the midpoint of where they expect rates to be in the longer term. And you can kind of see where the majority lies. And this is where the market can predict how many rate cuts are going to take place in a given year. So based on this dot plot alone, you can see that it looks like they're trying to get rates down below 4.5%. So it looks like they're trying to cut rates about another 50 basis points approximately during this year. Into next year, it looks like they're trying to cut rates down below 3.5%, potentially down to about 3%, which might be another 425 base point rate cuts or 100 base point rate cut total. And then they can see the rate begin to kind of stabilize through 2026, 27, and the longer term. So really what this is showing is where they expect rates to be in the longer term and kind of how they expect to get there. Generally speaking, a nice slow progression down. And again, the Federal Reserve is generally speaking supposed to be skilled economists. They're supposed to be advised by skilled economists. So I'm not in a position to provide my feedback if I think they're right, if I think they're wrong. Whatever I say and most other people on the internet say really don't matter. And a lot of the discourse that you might notice online, if you find yourself looking on, websites and things like that for commentary on this sort of thing, is a lot of people have a lot of negative things to say about how the Federal Reserve handled this cycle. But all things considered, realistically, just based on the data alone, they've certainly done an excellent job. And maybe that's an opinion, but anyway. All right. So anyway, this is kind of the big idea of the information that came out today. And this is really the reason that we see the price action that we do after every single FOMC meeting. These summary of economic projections aren't released every single time. However, they always release these meeting minutes here. And they also always or typically have a press conference as well with Jerome Powell, where he can go ahead and answer any questions. So anyway, today the Federal Reserve took a 50 basis point cut. This was the first time that they started a rate cut cycle with 50 basis points since 2007. So maybe some kind of spookiness with that. But all in all, that's kind of a big summary, big idea, the summary of what happened today. Any other questions, comments, concerns here? Happy to hear it, Christian. And yeah, Tilio is certainly still the expert on this stuff. Everything that I've learned is pretty much from him, and just looking into this stuff. But anyway, cool. All right. Do I think regionals look attractive here? I'm kind of in the camp with Tilio just in general. Um, After today, I think it's super reasonable to be a bit patient. If you're just paying attention to technicals alone, this specific day, this bar would typically be regarded as bearish, right? We swept above all-time highs at this 565 area. We closed near the low of day on rising sell volume. This isn't typically a bullish signal. Obviously, we're moving off of a catalyst, which is the FOMC. But Tilio said it pretty nicely in his tab, and generally speaking, I can't act like I disagree or even thought of this on my own. But generally speaking, you have to realize that we have a presidential election coming in what, 2 months, maybe even less than that at this point. And like Tilly mentioned, again, I'm pretty much directly quoting him at this point. With a tight race, there's a lot of uncertainty in that, right? Obviously the race is, I mean, I guess depending on who you ask, maybe some people wouldn't agree with you. But if we're being realistic and truthful here, the race is likely pretty tight. I mean, there's no clear winner right now. No matter what anybody tells you, it doesn't matter until the results are counted. So obviously the market isn't going to love that, right? They want to know with certainty what's going to happen in the future, right? That's what big money invests on, right? They're investing based on future value that they think they can gain. And when the policy outlook for the next 4 years isn't as clear, that's going to lead people to be more hesitant, right? Especially after an FOMC meeting, especially after a historically kind of bearish, or not necessarily bearish, but volatile month. We've already been seeing that. It's pretty reasonable to just kind of continue to be patient, continue to take a bit of a back seat. And yeah, I'm potentially more in the camp, again, effectively directly quoting Tilio at this point, but I do 100% agree with him, is stay cash, at least as it relates to a longer term buy, and wait for kind of the inevitable dip that's going to come into those presidential elections. I'm not in any of a rush personally. After a day like today, it's not something that you want to just be balls to the wall long until we can really get confidently back above these all-time highs. If now is the time when you think it's the most optimal day to get long, I think I would love to see wherever you're buying that product that you're smoking, because honestly, I don't see the excitement to be just incredibly long where we're currently trading. Right, there's plenty of opportunities to get long lower. Even on a day like this, right? If you really wanted to get long or get into something, that would have been the day to do it. Right, or even when we got this cross back here, right, that would have been a reasonable opportunity to try and take some longs there. But right now, right as we're pushing and just rejected all-time highs, to me, it kind of doesn't make any sense to at least either be patient for a retest lower or just wait for that move back above all-time highs, in my opinion, right? Then that's for more of a medium to long-term position. Obviously, anything short-term could work. Like right now, if you swung calls for tomorrow, the SPY's up, a couple bucks after hours. Anyway, that's the Fed. That's the impact that they have. Last thing that I'll say is that these meetings will continue to be incredibly important, and also will likely continue to act as significant pivot points in the market. Generally speaking, the Fed is pretty much kind of the number one, I guess, entity that market participants are concerned of in terms of the decisions that they make. So as a result, right, we have to be really mindful of what's going on. And this is kind of the one thing to certainly be paying attention to and be mindful of if you're trying to be a bit more data driven in the trading decisions that you make. So we got 2 more FOMC meetings throughout the end of the year. Based on the Federal Reserve's projections that they provided today, they are thinking that the federal funds rate will be around 4.4% by the end of 2024. And considering that today the federal funds rate was reduced to 4.75 to 5%, that means that we need at least 1 or 2 more rate cuts to get there. So we should be looking out for that at the next couple meetings. Let's see if we can even pull that up. Fed funds rate projections. Let's see. I don't remember what website this is on. That's not it. Fed funds rate probability. That's what I'm looking for. There we go. Right, so there's a CME tool. Obviously, it's just a probability, so I wouldn't take it with too much. I wouldn't treat this as kind of law. But you can see here, it describes what the market is generally pricing in for the future Federal Reserve meetings. So you can see at the next Fed meeting in November, they're either expecting, right now, the highest probability is a 70% chance for a 25 basis point cut and a 30% chance for a 50 basis point cut. And it also kind of shows you how these probabilities have changed over time. So just a month ago, the market had a majority projection that rates would remain flat. And now all of a sudden, the majority projection is that rates will almost certainly be cut. There's no way that rates remain flat into the next meeting. And that should be reflected similarly into December at this point. I don't know why I can't click any of this. Anyway, I can't click this for some reason, but not going to stress about it. So a lot of interesting tools that you can use to kind of look into this stuff a little bit, do a little bit more research into kind of figuring out why things are the way they are. Yeah. Anyway, this is kind of my favorite part of kind of the fundamental side of the market. I really enjoy this stuff. I think it's pretty fascinating. So any comments, questions, concerns before we keep going? If not, I really want to tailor the lecture that we have tonight for the next 30 minutes to really the audience here. Like I said, we've given a lecture on candlesticks basics before multiple times. So I don't feel like there's too much value in me just repeating that. So I really want to tailor this lecture to whatever you guys are thinking. So I don't know if it would be helpful for us to just start reviewing a bunch of charts and just talk through our perspective and kind of focus on kind of candlestick analysis. That would be kind of my idea for the best way to move forward. If you guys would like, obviously I have a PowerPoint on all this, so I could go through the whole spiel, look at the slides, we could talk about all that. But there's plenty of recordings of that lecture. I don't really see much value in us doing that. I think honestly, the value at this point is really us looking through charts and just talking about kind of some analysis and focus on candlesticks. All right, Cookie says new here, so review a few, that'd be great. All right, let's do a compromise. We'll review just a couple. We'll review that they exist. Yeah. All right. I got it. All right. Candlestick cheat sheet. So I want to just talk about this really quick. There's two cheat sheets for this. Let's see, candlestick cheat sheet. Okay, so instead of giving the full lecture here, let's see if I can find this. That's not what I'm looking for. Okay, this is a really interesting graph. Okay, we'll open this up. I'm just going to zoom in so we don't see that website. Don't go to that website. All right. Close that, and let's open this in tab as well. Okay, so what I want to start off with is, for those of you who don't know, again, those of you who do know, bear with me. We'll spend about 5 minutes on this. Those of you who don't know, what we're looking at right now is a candlestick chart. And what the candlesticks represent is they represent historical and current price action in the financial markets. And it's just one of many ways to represent price action. So we could show this as a more typical line chart. Oops, that's the wrong thing. We could show this as a more typical line chart that looks something like this. Maybe something that you might be more used to. There's also plenty of other options, but I'm not going to cover every single one. So this is a candlestick chart. It was developed probably more than 100 years ago at this point, where people were drawing this all out manually. And the candlestick chart is essentially meant to be an easy way to quickly get a read on current and historical price action on financial assets. And there's a couple kind of important things to be mindful of. Each candlestick represents a specific time period. So we're on the 1 year, 1 day time frame, which means we're looking at a whole year of price action, and each candlestick is 1 day. If we go to the 5 day, 5 minute time frame, we see 5 days of price action back to last Wednesday, and each candlestick represents 5 minutes of price action. That said, candlesticks, if we zoom in a little bit, they have these bodies here, which are these big green and red blocks, and these wicks, which are these small green and red lines. The bodies represent the open and close of the period, and the wicks represent the highs and lows of the period. So for a red candlestick, the open is at the top of the bar up here, and the close is at the bottom of the bar down here. For a green candlestick, the open of the bar is at the bottom here, and the close of the bar is at the bottom or at the top here. So should be kind of intuitive. It's opposite, right? A green candlestick, or a bullish candlestick, as you might hear it referred to as, represents an increase in price over a time period, whereas a bearish candlestick represents a decrease in price over a given time period. So with that said, that is the basic introduction to candlesticks. Specifically, Cookies asked about that. Cookies, are you clear on that? I know we blew through it really quick, but we'll talk about some patterns as well really quick with the cheat sheets as well. Again, also, I have done this lecture probably 3, 4, 5 times in the last 3 years, with a lot more detail. So if you feel like you need more detail, definitely couldn't encourage you more to look at that. So I'm not going to focus on this too much, but there's a lot of kind of candlestick patterns that can typically be regarded as some kind of signal to, that might signify that price action is bullish or bearish. So this exists. This isn't necessarily the best graphic in the world, to be honest. But honestly, I'd rather us not focus on this specific graphic. In general, right, it's not necessarily important to memorize a bunch of things in anything. If you understand the theories behind any given concept, you're able to reason without having to memorize everything. And for me personally, when I'm analyzing candlesticks and teaching the analysis of candlesticks, I much prefer to teach everybody how to actually think about this stuff rather than just how to, okay, what pattern is this? Okay, bullish, hanging man, or whatever. It's like that. You're never going to be doing that, right? So the intent isn't necessarily to have you guys memorize all this stuff, but rather have you understand why things are the way they are, why some patterns are bearish, why some patterns are bullish. So that said, this exists. There's plenty of cheat sheets out there that describe all the candlestick patterns that you could expect to see, but I'm not going to focus on that at all. And I'd rather focus on a graphic similar to this, which very simply shows the bullish and bearish strength of given candlesticks. And let's just talk about this for the next 2 minutes, then we're going to move on to the charts. So, and really quick, let me take a quick break. I know I speak really quick sometimes, so everybody feeling okay? Awesome. All right. All right, good. Great. So talking about this graphic, yeah, I know Husky, you're good. You don't need to give me the thumbs up, Husky. Just don't even say anything. All right. So talking through these specific examples, what I want to focus on is this, right? This is really the most important thing to be mindful of. So let's talk about this. First off, let's focus on the most bullish and most bearish candles, which are at the top, which it's kind of hard to tell what's exactly going on here. But these candles are essentially bars that opened at either the high or low of the day and closed at either the high or low of the day. They have a large spread, which essentially this means that one group of people, either bulls or bears, were in control of the price action all day and pretty much had no resistance whatsoever. So here we could see a day on the left here where price opened right here at this specific price and closed at the high of day, meaning that bulls were literally in control throughout this entire candlestick, which essentially represents strength, right? This means that whoever is in charge is clearly very interested in buying a given asset or equity at this point in time. And as a result, the trend is very strong or likely to continue to be strong in this direction. And same thing goes for the very bearish candle on the right, where price opened at the high of day and closed at the low of day, which very clearly indicates that sellers were in control all day. There was likely some aggressive selling taking place throughout the day in order to make this happen. And the fact that there is little to no wicks on both of these bars essentially represent that there was no point in time when buyers or sellers showed up. Like this day was effectively all buyers. This day, and I'm saying days, like this candlestick is a time frame of 1 day, but it applies to any time frame. Or this day where essentially sellers were in control all day and no buyers really showed up. And as we continue to move down the list, what you can see is 2 trends, right? Let's focus on the bull candlesticks. What we're seeing as we scroll down this list is we're seeing longer wicks in either direction. So the next weaker candlestick has more wicks in both directions. And finally, as we continue to move down, we're seeing price close below or further below the high of day, indicating that sellers stepped in with more force. On this day here, we're seeing that there was a lot of sellers at some time in the day, but we were able to kind of come back and close at the highs. But generally speaking, right, as we move down the list here, we're seeing price move further and further from the high of day, and we're seeing a larger wick form above that close price, indicating that sellers turned up in the end of the day. And let's just take a look at this really quick. Again, as it relates to bear strength, as we scroll down this list, we're seeing more wicks appear right on both the high and low side, and we're also seeing price close higher and higher above the low of day. And honestly, I'm going to move on from this graphic and just focus on this example. So here, for example, let's just try and focus on something easy. Let me go back just a bit. See if I want to draw that. Okay, so here, for example, we have a couple very bullish candlesticks as we progress throughout this breakout sequence, right? 1, 2, and 3. This first one appears as we break above the moving averages, right? Notice prior breaks above the moving averages. Here we had a pretty strong bar, right? That looked decent. We got some follow through, but not all the way. Here, we didn't have nearly as strong of a bar, right? Once we broke through the moving averages, we had a long wick to the upside, not really indicating any strength. Here, though, was the strongest breakout of the three. And let's talk about why. Here, we gapped up far above the previous day's close. So let's just see what this was. We gapped up almost a full percent, which that's a big gap overnight. We closed 2 whole percent higher than the previous day, which just to kind of compare here, what do we do here? We closed 1.5%-ish, a little bit less than that from the previous day. So we made a bigger percent gain on this bar. We have a very bullish candlestick, right, where there is no wick to the downside. Let me just zoom in a little bit. We have no wick to the downside, or a little tiny baby one, barely any wick to the upside, little tiny baby one, with a massive gap up, right? All this indicates to us is massive strength as we're coming off of these lows, right? But again, right, maybe you see this downtrend line that you've identified and you want to continue to be patient. Here, again, we see another massive, significant candle, right? Check this out. As we break this swing high right here, right, this high right around 438, we get this massive bar, again, closing near its highs on increasing volume, right, denoted by this yellow bar, over a key level, right? So again, another incredibly strong candle as we're breaking through these highs, right? So now we have 2 reasons that we can identify, 2 candlesticks alone that we can identify and say, okay, this looks pretty strong, right? This breakout clearly has steam. I want to take a quick step back. The reason why it's important to pay attention to this sort of price action is because ultimately, right, big money buyers aren't able to hide their buys and sells, right? They can do what they want, maybe through the dark pools or other specific instruments that they can try and use to obfuscate exactly what they're doing. But at the end of the day, yeah, it's totally sort of that whole sense. At the end of the day, price and volume never lie. And I'm going to try and stay away from talking too much about volume tonight, but price and volume never lie. And we're paying a lot of attention to price today, right? But again, we have 2 very strong bullish candlesticks. Especially if you could think back to our graphic, right? This was, per our graphic, the most strong bullish candlestick pattern. And this, although it has that downside wick, still closed at the high of day, right? So 2 really strong bull bars as we come off of this lows. What this means is that there is a lot of people buying after we hit these lows, right? Institutions are very smart, right? The traders, or I'll say the funds and traders that make the most money, are always going to buy at the right time, right? It's going to be a lot harder for us to do that. But as traders, what we can do best is follow what smart money is doing, right? We don't have the opportunity to move financial markets. I don't think anybody in here will unfortunately ever have a sum of money. Maybe you'll work for someone, or maybe you'll be able to start your own fund. But personally, most of us probably won't ever have a sum of money that we can use to influence financial markets to the significance that funds can, unless we have, billions of dollars laying around that we can just throw into some given asset, right? Which I doubt most of us are ever going to have that. Not saying I'm doubting all of us, but you know, that's like top 100 billionaire status, which maybe we're blessed. Maybe we're blessed with one of those people's presence tonight. So if they are, I accept loans. Yeah, give you a couple months, Aaron. Yeah, me too. Anyway, so we have two really strong bars, right? One is we're coming out of these lows, leaving two gaps behind, and another as we break these prior swing highs. Finally, right? Let's say, for example, again, you're being very patient and you're waiting for us to crack this trend. Well, we cracked this trend with another massive gap up. Bull bar didn't close all the way at the highs, right? Didn't close all the way at the highs, but still another massive gap up. We have a three separate instances indicating incredible strength here, right? Very clearly the market is strong. Very clearly buyers are stepping in here. And if you zoom out, what happened after that? There's no coincidence that the market has rallied over 120 points, 26% in about a year after that. That is not coincidental. And this pattern continues to happen, right? When we see those strong bars on a breakout, it is very common to see that same sort of behavior, right? Let's find another good one. Here, for example, again, another breakout above the moving averages. I mean, even here is a good one too, right? Breaking through the moving averages, bull bar closing near its high on elevated volume, right? That's one sign to maybe start thinking about getting long. Here, another bull bar, huge gap up throughout the day on increasing volume, bull bar closing near its high, right? At this point, you should be able to identify, okay, very clearly this has been a reversal, right? So that's kind of the fundamentals of candlesticks. Me personally, I'm less concerned about you all being able to look at something and say, that's a hammer, that's a, whatever, right? Sure, that matters. However, you should understand why something is bullish, why something is bearish, and use that in your analysis. And again, this works the same way, right? Here, we have a very significant bear bar, right? We have a gap down, bear bar closing near its low. We didn't go directly lower, right? We didn't go straight down, right? And that's not always going to happen. But this was very clearly an indication of weakness. And we've gone through this exercise before in lecture, so I'm not going to repeat it again. But find me another candle that's a bear bar closing near its low with a gap down. There's two. Here and here, pretty much. And here. Every single time, price continued lower. Oh, there's one here that didn't work, just to be transparent. But every time we see that gap up and price move in one direction and close at either the high or low, that is very typically an indication that price will continue in that direction. Does that make sense to everybody? Cool. All right. So let's go through some charts. Norman suggested a couple. I'm not going to do those first. We're going to do the charts that matter the most first, Norman, and then we'll get into your own. And let's just do a quick analysis of kind of the more current candlesticks. So we'll start with SPY. Obviously, right, SPY is trading near the all-time highs, right? No way around that. Just a couple levels that I'd be mindful of are probably the all-time high level, right around 565.16. Probably this pivot right around here, right around 540. These prior highs around here, and then now this swing low. These are probably the most important levels that I'd be paying attention to. Finally, we could probably draw a little trend like that to start being mindful of as well. Now, in terms of looking at candlesticks, right, we have a bear bar closing near its low with a long downs or a large upside wick off of all-time highs, right? This is very clearly a significant rejection of this level, right? This is not a bullish candlestick that you would like to see in order for price to continue higher. And I'll be the first to admit, right, candlestick patterns aren't 100% reliable. One great example of the candlestick pattern failing is this one right here, where you have this bar that looks actually pretty decent, right? It's a bull bar closing near its high. You have rising volume. You're breaking this little trend. And the very next day, we gapped down and broke support. So this isn't always going to work, right? There's multiple things that you have to be considering. However, if we're paying attention to candles alone here, right, this is not a bullish signal, right? This is not a reason to be jumping out of your seat and getting long, right? After a day like this, you have, again, bear bar closing near its low, long upside wick, that's a strong rejection, right? That's a textbook strong rejection. And after a strong rejection, it's not typically favorable to just get long, right? Anyway, that's the first example. Let's move on to the cues. And we'll go through a similar exercise. Let's clear all this up. Oops. And I'm kind of blowing through it, but I'm just trying to give you guys a quick, just brief workflow into how I would look at things from kind of this mindset. So typically, before I do any kind of sort of candlestick analysis, I always want to make sure I have some kind of key levels, right? So for me personally, I'd be drawing this trend, which again, not a very bullish candlestick off that trend, not very bullish. I draw this trend. I take a look at the volume profile, find any levels of support that seem to be important, which for the cues, I don't know why we're looking at the 2-year. For the cues, it looks like we got some support right around here and also down around here. So let's turn that back off. Go here. And get a couple levels going. So obviously this pivot here is going to be important in the short term here. Mark that off. This low here will be important. No gaps to be too mindful of. Some kind of intermediate level right around there in the middle, a couple wicks off of that. And then maybe a trend from below, something like that. Okay. So cues, again, similar take, right? We're seeing those bears kind of step in here right off this level of resistance. It's not something that really excites me, right? It's not something that I'm jumping out of my seat to get long on, right? And some people might be more excited about it. Some people might be thinking, oh, this is a beautiful setup, whatever. Me personally, if I'm paying attention to candlesticks alone, it's a great time to just be a bit patient, right? Cool. So QQQ, pretty quick. Let's just take a look at a couple more, maybe something like a Tesla. Let's try this out real quick. Again, just going to kind of clean everything up here. Tesla, again, right? Similar sort of candlestick pattern. We have 2 of these wicks off the same area, 2 bear bars closing near their lows off of these highs. Again, not really something that I'm just jumping out of my seat to get long on, right? It's really not something that is exciting me right now, right? There's very clearly some sellers in this zone. So as a result, right, just looking at these candles alone, seems like a good time to be patient for either some more obvious buyers, right? So maybe some kind of nicer looking bull setup or a break of this level. So again, let's just go ahead and draw some of these levels out. So you have this 235, maybe even take a quick look at the weekly here, see if there's any larger trends to be mindful of. Maybe something here. Kind of, not quite. We can see just looking at the moving averages, we're right at the weekly 200, and that's the level that we're rejecting. So that completely makes sense, and I'm actually going to change how I mark this level. So it's 235. Let's see, 235.59, 235.59. And then what I like to do is mark it as 200 weekly moving average and give it a color. I like to make it orange and show name on the right. Now, when I go to the daily, I can see I have that 200 weekly moving average marked, which today Tesla rejected directly off of that 200 weekly moving average, which obviously not a place we want to get long, right? That's a big level of resistance. We have a nice bear rejection off of that level. It's a great time to just be patient, right? Either wait for a break above that 200 weekly moving average or a nice setup into support below. Again, maybe a couple trends that we could draw here on Tesla, maybe this little uptrend right here that we could be watching out for, something like this. We could take a look and see if there's any kind of significant support in the area. Okay, a bit of a messy chart here. Honestly, I kind of need to zoom into the 4-hour to see a bit more clearly what's going on. Yeah, even that's a bit messy. Not really any concrete levels in this area besides like this 228. Maybe down here. Anyway, I don't really see any other levels that I really like in the short term in this quick analysis that I'm doing here. But anyway, again, Tesla, another great one to probably be a bit patient on, right? Nice long upside wick off of resistance, bear bar closing near its low. We got a bit of rising volume, not a bullish pattern, right? So there's 2 things that we could do. We could wait for the setup to develop and wait to see if maybe we get a nice bull bar off of some of these lows, or wait to see if we break this level of resistance, right? That would mean that these sellers that were previously present at this level of resistance have now been overwhelmed, which is a great sign for bulls. All right, so that was just a couple kind of speed run tickers. We'll take a look at some names that you guys put in chat just to see if there's anything interesting going on. If there's no interesting kind of candlestick setup to talk about, I'm just going to keep going. All right, Cart. The hell is this? Cart Maple Bear Inc. I thought this was Instacart. Is this not Instacart? Why is it called Maple Bear? Hang on. Now I'm confused. Oh, okay. It's just a fictitious business name. Okay, never mind. Maple Bear. Okay, anyway, Norman, this is a very interesting example, right? This is a very interesting example. On a day like today, where a lot of the market closed lower, you have this name, Instacart, breaking highs on rising volume, right? You have a nice bull bar through these all-time highs, but 52-week highs on rising volume. This is very intriguing, Norman. It's a bit extended from the moving averages, but this is one to keep on the watch list for a little bit. This is actually a very interesting setup. So very clear, strong breakout above these highs. There's no denying that, right? We have a bull bar closing near its high and on rising volume. On top of that, right, what did the rest of the market do today? Right, let's just look at other kind of, I guess, small caps. All right, looking at IWM, we have a massive rejection off of this resistance level, right? SPY, we know what that looks like. QQQ, we know what that looks like, right? So the overall market was closed as a bear bar near its low. Instacart closed as a bull bar near its high. So that's a nice kind of anomaly and discrepancy to pay attention to, right? So this is actually a very bullish indication and not necessarily the place to get long right now for a long-term trade. However, certainly something to start to be mindful of. Also with this nice base that was built out too. Norman, this is one of the better names that you've actually sent in a while. This is pretty nice. Yeah, I actually like this, Norman. This one looks like it wants to keep ripping into this earnings report, honestly. It's a bit extended in the short term. Probably not the place to get long right now, but any kind of consolidation, like if we consolidate around this area for like 2, 3, 4 days, this would be a really nice setup. I actually really like this, Norman. This is a nice find. Good for you. And great example too. Thank you. Just because of that, Norman, I'm going to look at another one that you just posted, whatever the hell this is. All right, this is exciting. Sorry, I'm going to skip that. I got too excited. All right, let's look at Celsius. Yeah, so Celsius, no real kind of short-term candlestick patterns to go off, right? If anything, it's very clear what the trend is. You can see the only kind of strong pattern is all to the downside, right? Look at the strongest bars in the short term. We have no real strong bull bars besides this, but it didn't even really clear a significant level of resistance. All of our strong price action is to the downside. Here, big fat bear bar closing near its low. Here, multiple bear bars closing near its low after gaps down, small rally, and then a big bear bar closing near its low after multiple days of price moving higher. Here, right, we have this big bear bar moving near its low, and it's taken us almost 10 trading days to even retrace half of it. So Celsius, great example of super, super weak price action. There's no buyers here right now. Let's look on a weekly and see where we're at. Yeah, I mean, it's certainly getting cheaper. That's for sure. Oh yeah, and we're at a big area of demand on Celsius. Yeah, not a bad place to buy if you're looking long term, but certainly not a great case study for the candlestick pattern. So I'm not going to talk about it any longer. But yeah, if you're interested in long term, you got a nice buy right around the 32 area, or at least a stop below the 32 area. Point of control on the weekly shelf. All right, XLE, take a look. Actually, it's not bad. Yeah, today in specific, nothing super notable. But here, really nice example of kind of a bottom, right? As we progressed lower, we started to see these nice long downside wicks on these sell days, indicating the presence of buyers, kind of an impending reversal. But for right now, not any kind of setup that I would really act on for XLE. All right, LMND, let's see. Again, if I skip the ticker that you asked for, it's not because I don't think it's a great idea. I just don't think it's a good example for candlesticks. Oh yeah, this is a really interesting one. Let's start here. First big bull bar here led to a massive rally, right? Breaking these highs, no surprise there. First big bear bar with the better gap down led significantly lower. Nice continuation of the downside there. Interesting one here where we have two massive bull bars breaking these highs and then an earnings report retracing the whole thing. This is an interesting one for sure. I think generally speaking, this is just a nice case study of kind of seeing those nice widespread high volume days and the amount of follow through that typically happens with those. But obviously doesn't always work that way. All right, Etsy, let's see ETSY. Etsy, yeah, again, nothing really too significant from the candle side here, so I'm going to probably keep moving. Not that I don't necessarily like it at all, but not something that I can really use as an example for this one. All right, VST, yeah, nothing right now. Norvin, VRT, nothing specific right now, but clearly this break of the downtrend is exactly what we would be looking for, right? Which I don't know how I missed that. Anyway, yeah, nice big bull bar as we get through this downtrend. This is very clearly a reasonably bullish pattern. XOM, all right, look at XOM, look at PLTR, we'll look at Apple, then we'll answer Aaron's question. XOM, nothing super notable right now. Looks pretty similar to XLE. PLTR, I think pretty good example of what happens when we break these highs. This was here on the S&P 500 inclusion day, right? We broke these highs on the day that it was included in the S&P 500 and then continued much higher so far. We're up about another 5% after that inclusion. Again, right, just a nice example of a big bull bar can do in terms of follow through. But yeah, in terms of short-term patterns, yeah, nothing real crazy. All right, Apple last one, and then we'll answer Aaron's question. Apple, actually kind of decent, just kind of outperforming the market. It didn't really break any significant highs. It's moved off of support, but I think one to watch just based on price action alone, considering it outperformed like everything else. They also just released what is it, iPhone 16. So yeah, something for investors to continue to react to. Probably in that earnings report upcoming, we'll see what the demand was for that new phone. I don't know about you guys, but it's not anything too special. But anyway. All right, last thing, Aaron asked if I could talk about fair value gaps at all. I'll just preface this by saying I'm not an expert on fair value gaps. And I don't really trade them. And I think if you really wanted to learn fair value gaps, you should learn that from Al Brooks. He's got some videos on it. I think he calls them negative gaps, which is that's where that concept was really derived from, is from Al Brooks. But a fair value gap, pretty much like simply put, is, I don't even really know how to explain it in words without just giving an example. So I'll just give the example. A fair value gap is essentially this, where the body of a candle isn't like surrounded by wicks. God, that's such a terrible explanation. Never actually had to explain this, to be honest. Let's see. So like this, I think, is a fair value gap right here. So you can see we have this area between these two wicks on this bar, and this should have acted as a level of resistance intraday. We can look. Okay, that's not far back enough. Yeah, okay, so you kind of see that, how it kind of acted like a level of resistance here on the 4 hour. Yeah, that's honestly that's the best explanation I can give, Aaron, honestly. I don't trade them. I've never had to teach it before, so you're the first person to ask me this question. Yeah, this is the only way I could really explain them. The only things that I know about them are that typically they matter more when you're breaking some kind of key level, which some of the people that teach it have some BS acronyms and names for it. But all it is the fair value gaps are more important after you break a key level. So like this one's important after you break these highs, and this would be the fair value gap to draw there, something like that. So essentially like that area between those two wicks. Does that help, Aaron? Like I said, I don't trade these, and yeah, not the expert on them. I can't act like I know everything about them, but we can talk like separately too, and I could try and explain a bit better, but that's okay, cool. Yeah, Al Brooks, search up Al Brooks. I think he calls them negative gaps. I know you probably got that concept from like some ICT stuff, but that guy's, I don't know, he's a little out there. I don't think he's actually that good of a trader. I think Al Brooks is certainly a legend. So anyway, all right, everybody. That's a bit, but hope you guys enjoyed the variety. And with that said, that's gonna do it for us. So you guys all have a great rest of your evening, and I'll see you